I proceed under the assumption that sometime in the next 5 years, some event, liquidity squeeze, recession, whatever, will occur. And it will take equity markets down by between 30 and 50%. Now, I have two choices. I can stay out of the market, or I can maintain enough liquidity and have a high enough quality portfolio that my portfolio, A, will come back, and B, I can use my liquidity to buy other people's mistakes. For people who use the fear of recession as an excuse to stay out of the market, those people will consign themselves to performance mediocrity.
In today's market recap, this silver bull still has strong legs. Last month, silver cracked the key resistance of $30 an ounce level for the first time in over a decade. It's been quite a bull run for silver, and Chen Lin thinks it has plenty of legs left. As Lin noted, the last time silver broke $30, 2011, after a minor consolidation, it quickly ran up to $50 an ounce. Lin focused on two factors in place that could quickly drive the price of silver higher. The first is the movement of silver from west to east, similar to the trend we've seen in gold. Lin points out that silver stocks at the Shanghai Futures Exchange have fallen to a 10-year low. Meanwhile, investment demand for silver in China exploded recently, with the silver premium in the Shanghai market running about 10% over New York. We saw a similar phenomenon for gold in China late in 2023, right before the big price rally in the yellow metal. That means massive silver will be going from the west to the east, just like gold, and we should see a continued sharp rally in the silver price. Lin said Chinese investors are turning to gold and silver as a way to cope with negative real interest rates and sagging equity prices. A second factor is a global silver supply squeeze. Silver demand outstripped supply for the third straight year in 2023, leading to a significant structural supply deficit of 184.3 million ounces. Now, we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
I no longer invest outside of natural resources and conventional financial services. There's all kinds of cool sounding stuff out there, but I don't know how to know it's true. And there is enough opportunity for me in subjects that I have 50 years of experience in that I don't find it necessary to relearn the lessons that I learned by making mistakes in resources and conventional financial services in the first 10 years of my career. And I would suggest that that's what Buffett says. What Buffett says is if he doesn't understand it, he doesn't want to do it. He points out that he's made enough mistakes and stuff he understands that there's no particular need to go outside of his circle of competence and find ways to make new mistakes. His methodology is very much finding fairly dominant businesses that have good margins, can use leverage, but employ it only modestly so that they can lever up their balance sheet in bad markets and expand. And companies who are tax efficient to the extent that they return capital to shareholders via share buybacks as opposed to dividends. That's a wonderful strategy. There are people who point out that other people have got richer quicker. What they don't point out is that those people who got richer have not given over half their net worth to philanthropy yet. Buffett's third in the list because he's given away half his net worth. And what he has been able to do has entailed substantially less risk than what the other guys have done. It is important not just to look at who made the most money, because if you're trying to apply that to yourself, all of these guys are smarter than we are, and they all work harder than we are. What's important to me is risk-adjusted returns. And in terms of risk-adjusted return, because Buffett eschewed risk, the returns that he's generated on a risk-weighted basis are way better than the other guys. I mean, there's no comparison. Buffett has also said he doesn't need gold. And I think that's a much more important statement. If you look back to the decade of the 1970s, when gold, of course, did extraordinarily well, what Buffett pointed out was that high quality companies that had operating leverage, that could increase their prices, that were price makers, not price takers, were great hedges against inflation. Companies that had to invest a whole bunch of money in property, plant, and equipment were stymied by inflation, but companies that had already established those positions weren't. I guess what I'm trying to say is Buffett is smarter than I am, so he doesn't need gold. I'm not as smart as Buffett, so I need gold.
That's a really interesting way to look at that, Rick. I think that's it's I guess an admission of humility on your part, but an interesting answer nonetheless.
Listen, I mean, I've studied what he does, and I've studied it carefully. I haven't just read every shareholder letter and every annual report. I've read them in some detail, and he tells you very, very, very clearly how he does what he does. And much more importantly, he describes in gruesome detail his mistakes. As an example, his forays into airlines. Having seen that, would I have identified Coca-Cola as an investment at the time he did it? Would I have been as sophisticated as Warren Buffett was and as able to utilize the methodology that he utilizes to achieve the same results? Probably not. Probably not. That's why I've chosen to stick to industries that I know very, very, very well. After 50 years in the business, I understand what makes a good oil company, either a major producer or an explorer. I understand what makes a good mining company. I understand how the timberland cycle works. I understand how some farmland cycles work. I understand community banking. I understand the insurance business. Within my own circle of competence, there is more opportunity than I will possibly be able to access for the rest of my life. So my temptation to go into stocks that would require a knowledge of popular culture, let's say communication stocks, or technology stocks, or cryptos. I hope people make trillions there. I have no fear of missing out, and I have no envy of other people's success. I want to make reasonable amounts of money for the rest of my life. By the way, my wife and I, second to die, will basically give away our entire estate to philanthropy. So I'm doing this to give away more, not to live better. But the truth is, there's all the opportunity I need within my circle of competence.
In the continuation of the episode, Rule pointed out that the historical performance of gold in uncertain times offers a clue to its future potential. He noted that gold has traditionally done well when faith in traditional savings instruments wanes. With a sharp eye on economic trends and geopolitical shifts, investors like Rule see significant opportunities. He emphasized the importance of understanding the broader economic landscape to appreciate why gold could be a valuable component of an investment portfolio. However, Rule also highlighted the importance of patience in the realm of precious metals investing. Drawing on lessons from legendary investor Warren Buffett, he stressed the importance of compounding, allowing investments to grow over time through reinvestment of returns. For gold and silver, this might mean enduring periods of stagnation or minor losses, awaiting the long-term gains that historically accompany precious metals. Now we'll show you more clips, but first, like, subscribe, and turn on notifications as people who regularly watch our channel are better informed.
I think with regards to money, patience is the first. You would like, of course, to have confirmation of your investment thesis in the near term. but it isn't normally offered up in the near term. And as Warren Buffett points out, a pretty good investor, as you know, that the first wonder of the financial world is compounding. If you don't have patience, you can't enjoy compounding. Compounding seems like a strange concept with penny exploration stocks. But the truth is that the path to discovery may have 10 or 12 steps. If you get the first step right, you need to ask yourself about the second step, and then the third step, and the fourth step, and the fifth step. So compounding is important in penny stocks too. When I look back at my career over those 10 baggers I've enjoyed, or 20 baggers, or even 100 baggers, what I find is that although I wanted performance in the near term, it took me an average of 5 or 6 years to enjoy 10 baggers, to the extent that in my mind, I had a frame of reference with regards to time that was incorrect. I was my own worst enemy. Mm-hmm. I would say the second is persistence and tenacity. That same quest for 10 baggers has in almost every case exposed me to a 50% decline in the share price of a stock when I was holding it. If I liked it at $2, I better like it at $1. I better revisit my premise, mm-hmm. but I better like it again. I would say, and this is in no particular order, but the third is really the importance of people. People in two senses. We've talked on your show before, Tom, about Pareto's law, about the so-called 80-20 rule, how 20% of the people generate 80% of the utility, mm-hmm. How a different 20% of the people generate 80% of the aggravation, and the importance of hanging out with the good 20 rather than the bad 20. We've talked, too, about the fact that if you put the good or the bad lip through the same performance dispersal curve, that they conformably align, which is to suggest that 20% of the 20% do 80% of the 80%. So 4% of the population generates 65% of the utility. That's important. Mm-hmm. But there's another thing about people. Bad people wreck great deals. I was told once by a pretty good speculator that the rocks didn't care who owned them, and that I needed to be, how would you say, a bit more tolerant about who I hung out with. That turns out not to be true. High-quality people generate high-quality outcomes. They are more likely to come into contact with good rocks, and they are more likely to care about treating other people well. Some years ago, I remember getting a phone call from a woman who was a receptionist, the lowest paid person on the payroll at Silver Standard, thanking me for my efforts around Silver Standard and telling me that as a consequence of the stock options that Bob Quartermain gave her, as opposed to keeping them for himself, that she was able to put down a down payment on a condo, something that otherwise wouldn't have been available to her. Mm-hmm. Now, while that speaks volumes about what a good person Bob Quartermain is, it also fosters the wonderful team who, when it is necessary, is willing to put in 14 hours or 16 hours for the benefit of the team. So it turns out that people have to be not merely competent, but good. I think the last thing I need to say, Tom, and it's been a strategy of mine for a long time, is that in capital-intensive cyclical businesses, you have to be a contrarian or you're going to be a victim. You have to buy stuff when it's out of favor, and you have to buy markets when markets are in disarray. I've come really, truly to love hate. I look through social media commentary in areas that I'm close to, and I look for a preponderance of negative sentiment. I know, as an example, that the sentiment that surrounded the silver trade after the sort of bust of the so-called silver squeeze was extremely bullish. There's no hatred as sincere as the hatred of a jilted lover. And all the hate that silver experienced after the silver squeeze didn't materialize meant that the last seller had already been squeezed out of the silver juniors. It's odd that you look for hate as a leading positive indicator, but I've learned it's absolutely positively the case.
Mhm.
That's probably enough pontification from me. There's enough there for people to chew on. And there's enough there that's challenging. People want, not that it matters, they want stuff to take place in a short period of time.
Mhm.
Turns out the cosmos doesn't give a damn what we want.
What do you think of Rule's take? Is he spot on? Will silver hit $50 this year? Post in the comment section your price predictions for gold and silver for the end of the year and share this video with a gold bug. Now watch this video right here because it's a perfect fit for you.